Hi, everyone. Welcome to the Seattle Angel Workshop Series. Today, we're going to do a deep dive into the question of angel investing and taxes and sort of some of the sharp edges of that journey. And today, we have a panel we're putting together to talk about where there might be some advantages and where there might be some trouble associated with how you do your angel investing. So before we get going, let's introduce the panel. Joseph, you want to introduce yourself? You're on mute.
Sorry about that. Joseph Templeberg, Managing Director at Templeberg and Associates Limited. We deal with a lot of regulatory compliance for our clients, including SOX, PCAOB frameworks. Our focus is on startups, private equities, investors, both whether you're seed, whether you're pre-seed, seed, angel investors. We hold your hand through that process. We also look at things through an ethical guidance as well, just to ensure that what you're doing, where the funds are coming from, where the funds you're putting into are in sustainable type of investments. My background includes firms like MR Weiser, which is now Mazars USA, KPMG, and other healthcare portfolio and holdings. And the bottom line is the ability to simplify intricate problems and deliver pragmatic solutions. I could not say it better than when John summarized it in that sentence.
Yeah, cool. Thank you. Adam, how about you?
Hey everyone, I'm Adam Matherly. I'm a business attorney at a law firm called Carr Tuttle Campbell, based here in Seattle, Washington. And it's a full service firm, but my responsibilities are heading up our emerging entities and venture capital practice group. So I've worked with a lot of startups, entrepreneurs on the one hand, and with funds on the other hand. And we've been a legal sponsor of Seattle Angel Conference for quite a while, and have also served as legal counsel for SAC and its affiliated funds. So good to be here.
Cool. Thanks for being here, and thanks for supporting SAC for all these years. Peter, how about you?
I'm Peter Weiss. For more than 25 years now, I have been an early stage CFO and finance person, as well as the utility infielder for management teams who need to fill in a lot of other expertise, since I have worked for all kinds of companies and filled all kinds of roles. Over the years, I have done probably worked for something north of 100, 120 different young companies, from anywhere from creating the entity through high growth stage periods. Also very active angel investor. Guessing we've probably done over 100 companies, probably 150 investments over the years. Very active in a number of angel groups. I've been on the screening committee for when it was in Operation Zeno, and then Puget Sound Venture Club and Alliance of Angels. And I am the managing member of the Swan Angel Funds, as well as member of half a dozen other angel funds, and manager for probably a dozen SPVs. So seen it all, and made lots of mistakes, which hopefully I'll help the audience avoid making in the future, because they don't have to. I already have.
Yes, we all do that on a regular basis. Always good to learn from others. And I'm John Seacrest. I'm the founder of Seattle Angel Conference and a follow-on program called the Transatlantic Angel Conference, where we enable new angel investors to discover angel investing by doing a group angel investment. Our 26th cycle is coming up, and this is part of the process of getting to that. I'll post some deadlines and such into the chat as we go along. But today, when I think about doing an angel investment, I'm taking my money that I can afford to lose, and I'm putting it into this very early startup. And perhaps that will win, and perhaps it won't. And there's a whole bunch of conversation we can have about that, which we've talked about in other workshops, which you can find on our YouTube channel. But when they win, then I have, maybe 10 times my money, 20 times my money coming back. and that might translate into having to pay taxes of some kind. But there are, of course, people who wish that we would do more angel investing, and so they set up opportunities for us to do that. And there are two specific pathways that we're going to end up talking about, and I'll just name them. They are the Rule 1202 QSBS opportunity, and they're also a Roth IRA opportunity. So let's sort of outline at the beginning, what is this Rule 1202 QSBS opportunity? And I think Adam has put together a little bit about that. You want to work on that, Adam?
I'll talk in English first, and then maybe I can show you a few slides of things to think about. I'm not a tax attorney. I'm a business attorney, but I'm confronted with kind of the issue of qualified small business stock frequently in my practice, both on the company side and the investor side. We're assuming kind of in the audience, the full range of kind of knowledge about the topic. Some of you may never have, you may know nothing about this topic, and others may have really dug in deep. So it's really overview level, but I'm sure we'll get into kind of deeper conversations about it too. So the concept of qualified small business stock, which is defined and described in section 1202 of the Internal Revenue Code. So it's often kind of, you'll hear two names for the same thing, qualified small business stock, or QSBS, and 1202, all kind of referring to the same concept. But the idea is we're talking about shares that are issued by a qualified small business, which entitle the holder to exclude from taxation a percentage of the gain upon the sale or exchange of the shares. And the percentage has changed over time, generally to the benefit of investors. This was first rolled out in 1993 as a kind of Clinton era tax legislation. As I mentioned, it's been modified several times since, generally kind of increasing the amount of the gains that can be excluded from taxation over the years. And so I can summarize by saying for QSBS issued after 2010, specifically September 28, 2010, holders of qualified small business stock are eligible to exclude 100% of the gain upon sale of these shares, but they're subject to caps. So it's capped at the greater of 10 million or 10 times your stock, your tax basis in the shares, the amount you paid for those shares generally. And just to kind of, I think it'd be useful just to see kind of the three basic examples, and that's really what I wanted to show on the slides. So I'm going to do that really briefly, if you don't mind, John.
Oh, that's great.
Okay. And then I'll share the floor.
So while you're doing that, this reminds me of the old Steve Martin joke, how to make $1 million and pay no taxes. And so here we are, actually with a legal pathway where I invest $50,000 and I get a 20x return, and I have $1 million that I would pay no taxes on.
So the others can check my math, and I'm trying to use, round, easy to digest numbers, which are on the high end. This is probably more kind of a venture capital firm level of investment in a company. But imagine you pay $2 million for qualified small business stock today in 2024, and you hold that stock for 5 years and sell for 10 million. Your gain is easy to calculate. It's $8 million, but you pay 0 federal income tax on that gain because you have the 100% exclusion. And 8 million of gain is under both $10 million, and it's also under 10 times your adjusted tax basis, which is $20 million in this example. So in this type of scenario, 0 federal income tax, there may be other applicable taxes, and just using kind of flat 20% long-term capital gains tax rates, it's a tax savings of something like 1.6 in this example. So really, really substantial. Let's say exact same fact pattern, but you sell for 20 instead of 10. Your gain is 18 million. You still pay 0 in federal income tax because that 18 million in gain is lower than 10 times your tax basis in the shares of 2 million is what you invested, 20 million is 10 times your tax basis, 18 lower than 20. So here a savings of 3.6. And then let's take a very extreme example. You invest 2 million, you sell for 30, you have this $28 million gain. You get to exclude up to 20 million in gain. You're going to be taxed on the remaining 8, but it's still obviously a substantial savings. So that's the general flavor of this. It's obviously he made it so that it's hugely critical first for investors. I mean, in the thesis of entire venture funds are built around kind of requiring qualified small business stock for their investments. And then obviously for companies that are trying to attract dollars.
Yeah, Vinay is asking the question, is there a cap on the 10x gain calculation?
You know what, off the cuff, I'm not sure. Peter, do you know the answer to that one?
It's the greater of 10 million or 10 times your original investment. So if you invested $50,000 and you got 30 times your investment, $1.5 million, you'd still only be able, or you'd be able to take all of it. If you invested $500,000 and you got a 20x return, so you're now at let's say 30, so you have 15 million, you get to exclude the 10 million.
Sure.
So whichever is better for you, either 10 times the investment or $10 million.
I think he's asking though, does it ever cap out? I mean, if I invest 100 million, is my 10 times, basis 1 billion, or is there some ultimate cap on all of this?
I have never heard it, but I've also never worried about it. I have to say, generally I have to stay just a tad under $100 million in my investments.
I really ought to use better numbers on this, but
So we'll assume that most of the angel investors are writing checks that are 50K or less. But there's another thing that's a problem that Peter just remembered.
Yes, which is the company cannot have more than $50 million of gross assets immediately prior to or immediately following. Frankly, the other thing is that outside of a family office, it would be very rare to see anyone writing an 8-figure check that really cares much about the taxation on the investment. VC firms, the majority of their LPs are untaxed nonprofits or insurance companies or people who pass through it. So this really is a tax benefit that really does fit the reasonably but not enormously wealthy investor. It really is an angel benefit, and it's aimed at exactly the people who I suspect are on this call.
Yeah.
May you all someday have so much money that this won't matter to you.
Yeah.
Right. And that's the term of the angel investor. You're coming in pre-seed. This is where the idea is formulated, and this is where you're investing. Anything up and above, then you're in venture capitalists, then you're in private equity, family wealth offices. But for people on the call here, like John and Peter and Adam are focusing on, you're not putting in big dollars and you're not risking. You're risking, but you're not risking your life savings here. That's not where you're getting.
But also let's keep in mind, let's say you have a pro rata right and you come into a later VC round. If the other criteria are met, you're still eligible for 1202. So this is very, very nice. But by the way, we'll get to this later. I once used it to exercise warrants. So there are all kinds of ways that, or I used it to fund a warrant exercise to keep the 1202 benefit. So there are lots of ways to play this And by the way, it doesn't matter what the round is labeled as long as it is an equity round. So whether it's seed, pre-seed, Series A, Series B, Series C1, John, Paul, George, and Ringo, it doesn't matter what the label is as long as it is an equity round.
Right. And so one of the problems that we've had with one of the investments in SAC that we think QSBS applies to is actually getting the data from everybody to get it so that we're in this right box, right? Because we start with a convertible note and it turns into a priced round at some point, and there's a clock that happens, right? That you have to hold it for 5 years. And so that 5-year holding period starts when you get the equity and ends 5 years later, right?
Yeah.
And sometimes things change in the middle. So how do we have, what things do we have to pay attention to in the middle of that to actually accomplish this thing?
So John, that's an interesting question. I think we should talk about convertibles versus shares. If you wouldn't mind, maybe I'll kind of complete my portion by saying what are the
Yeah.
basic requirements, because that really is an important piece of all this. So let me do this once more, and then I promise I'll be done with the slides and we can just make it a conversation. The requirements are these. On the company side, the issuing company of the shares has to be a domestic C corporation. So you have to be careful about this. You know, a lot of companies start life as an LLC, unless that's taxed for federal tax purposes as a C corporation. It's not going to work. It needs to be a C corporation at the time the shares are issued. Because of the legislative rule, this only applies to stock issued after the passage of that legislation. So, you know, if you're talking about very, very old issuances, this may not apply. There is a kind of asset value test and qualified business test, which is kind of interesting in that not all businesses does this apply to. There are certain types of businesses which are ineligible to issue qualified small business stock, and very generally they're listed here. These are the things that don't fly, and it's generally kind of professional services. I think performing arts and athletics is kind of is interesting, and then you can see hospitality types of services that don't work. But generally, I mean, you know, most of my clients in this space, they're either high technology companies or they're perhaps consumer product type companies, and those are generally eligible. These are not.
Right.
So going back to this, I mean, you have to use at least 80. The company that's issuing the stock has to use the vast majority of its assets to operate these qualified small businesses. Peter mentioned the total gross assets test, which is at all times and immediately after the issuance. The company has to actually be kind of a small business, and the IRS says that means $50 million or less in total gross assets. And then I always try to flag this. I mean, there's a couple ways that the company can kind of harm itself and be ineligible to issue qualified small business stock. And one is by purchasing back large quantities of its own shares from stockholders. There's exceptions to this rule, but certainly any company that's planning to do a redemption or repurchase back its own shares needs to talk with its legal counsel and plan that out carefully to make sure they're not harming their ability to issue QSBS. And then finally, on the taxpayer side, you got to acquire the stock directly from the company. You can't buy it secondhand, so you can't go purchase shares from another investor and have that qualify. Has to be acquired for money, property, or services. And the big one is you got to hold it 5 years, which is why I kind of used a 5-year sales date in those examples mentioned earlier. There's a 5-year holding period. And then again, I'm mentioning the redemptions. If the company's redeeming shares that you own, it could disqualify you from the preferred treatment. Okay, I'll I'll stop yapping about it. And
So, I go to an angel conference. We invest with a convertible note. So typically we're doing convertible notes, we're doing safes, or we're doing priced rounds of some kind. And those are not all the same, right? So I invest in a convertible note. The startup founder being happy with convertible notes, start stacking their convertible notes, you know, next round, next round, next round, 3, 4 rounds in, I'm deep in convertible notes. How does that impact my QSBS exemption?
Peter, if you'd like to talk on this topic, I'm open, of course, open
Sure.
to you taking the floor.
Okay, so number one, any company management or financial advisor or attorney who tells a young company that it's a good idea to stack lots of convertible notes and save should be taken out and punished severely, because it's a generally bad idea. But that's another meetup, or anyone can contact me directly and I can go on at length about it. Um, Convertible notes for this purpose are clearly distinct from safes. Convertible notes are debt. It says debt, and therefore it is not equity. When it becomes equity is the date that you do your tests. Number one, it's the date that your 5-year hold period begins. Number two, it's the day that you need to do the asset test. Now, you should know the date that it converts because the company should notify you and either do a new thing in Carta or whatever, a ShareWorks or whatever else they're using. But you need to reach out to the company and say, please send me a current balance sheet so that I can determine my QSBS 1202 status. Maybe they cooperate, maybe they don't. The fact is, most startups are not going to be anywhere close to that. So if I don't get that information, I don't lose sleep over it. I'm going to assert it, assuming I get my long enough hold period. Neither Adam nor Joseph can give you that advice, but I'm not a CPA, I'm not an attorney, I don't hold any other certifications or registrations, so I can tell you how to walk down a dark street with a CFO side by side advice. That is not legal advice, though. Safes also get a little complicated. There are two forms of safes. There are the safes that are designed to be debt. They have an interest rate attached to them. Those have kind of disappeared in the last 2 or 3 years, but if you have a safe that is a debt instrument, I tend to think that even though it says simple agreement for future equity, if it has debt characteristics, probably it's not going to qualify. As far as I know, the IRS has not given clear guidance on this issue. Safes that are intended to be equity, simple agreement for future equity, and do not have a label calling them debt and don't have debt characteristics of which the principal is interest. I am now told there have been private letter rulings, and from the date of investment and at the time of investment, the asset test starts from the time of investment. And I'm pretty comfortable with that until I hear something different from the IRS. So again, 3 different things. Convertible notes, clearly not. Safes that are labeled debt, almost certainly not. Safes that are labeled equity, you're probably fine. For the first 2, the convertible notes and the safes that are labeled debt, on the date of conversion, they matter. By the way, your basis on that day, if you have a convertible note or you have a debt safe, is if you don't take out your interest or the interest isn't paid out to you, is what you invested plus the accrued interest. By the way, they're also going to send you a 1099 on that if they're doing it right. But you do get a little bit more of a basis on that. So win some, lose some.
There we go. And so Nick just asked, what kind of safes does SAC do? SAC does whatever gets negotiated between the company and the SPV organizer, which could be a convertible note or a safe or a price round, depending on where that company is in its arc and who's leading which deal and all of that. It is the job of the SPV organizer to do the deal evaluation. That's part of the learn by doing effort for the SPV organizer. And so it can come in many different forms. In general, I have been of the opinion that safes are a terrible idea for angel investors. because it causes them to not be able to get the company back to the table when you want them back to the table. But having now gotten tons and tons of K1s that I don't really want, there are apparently ways to set up saves so that you don't generate K1s. And so somewhere in this conversation, we might talk about K1 tracking as one of the side effects of all of these things, and deal with that. We start the conversation with convertible note, which is pretty generic, because our goal is to give the company the opportunity to be wobbly in there and not have to say a price. But the more I stick my nose into this, the more I think a price round at a simple price is the right answer. And Joseph, you got a different opinion?
I don't know. I'm agreeing with you. I've been through this one too many times. And the simplest was when it's convertible. No, it's great. You know, it's not that it's great, but having that price round set up made life a lot easier. We had our bases. We were able to get something out of there. Moving on to the next rounds of fun, next rounds. The convertible notes also presented an issue. We had a client who got flagged by the IRS for their audit. And now you have to sit there and prove that this convertible note was really being turned into it. It's not some family or friend type of thing. Show your operating agreement, or show the shareholders agreement, which also leads into a discussion that we had prior to this call last week, where Peter was on board. Peter was emphasizing the importance of it being the C Corp rather than the LLC. And some of these issues with the IRS and other regulators goes away, not completely, but it goes away when you're a C Corp rather than the LLC. And I see that we did include in time to discuss those topics as well. And when we do, I'm going to defer that to Peter because he gave a great presentation on it last time.
Sounds good. I think that the question about who chooses the deal structure is an important one here to go down that rabbit hole. So everybody who's engaging in raising funds as a founder, they seem to think that there's a way to do it, and there's a bunch of different pathways. And so one of the reasons, well, let me ask you, Peter, you've done this longer than I have. Who gets to decide what the deal structure looks like for a startup? So Daniel starts his startup and he's going to put together some fundraising for it. Who gets to decide how that's set up? Now, we'll all agree that if you're taking outside money, there's no reason to do anything but a C Corp. Just set up your company as a C Corp. Just don't discuss the other paths, as far as I can tell. But then I get to choose. Am I doing a convertible note? How big of a round am I raising? What's my valuation? All of those kinds of questions. Who gets to choose that, Peter? You're on mute.
This is a willing buyer, willing seller conversation. I can tell you that if I am at the table on either side, either as a CFO or as an investor, I am going to tend to push hard for a priced round. By the way, my standard deal terms are 1x participating preferred. I'm not even interested in non-participating preferred. That's a whole nother conversation. But if I'm coming in late in a round that has already been funded substantially and there are already people who are in there, the company will tend to push back if they've used another structure. And I get to decide, am I okay with what they've offered me? Am I okay with this management team? Do I believe that they will treat me well and respect me in the future when whatever I'm being offered becomes equity? But it's a conversation. You can try to, if you're outside of equity, you can try to get contractual protections and rights. I've started to see that in safes where future terms will be spelled out, information rights and whatever. I think those are an excellent idea for every investor. If I'm writing for an early round, if I'm writing a $250,000 check, or I'm bringing a good chunk of that to the table along with my friends and affiliates, I could probably rewrite the term sheets. If I show and demonstrate responsibility and competence and knowledge, there's a very good chance, if I'm early in the raise, that I can change it into what I want it to be. I can tell you at the Swan Venture Funds, we push back very hard on unpriced rounds, and we push for 1x participating preferred. Sometimes we get it, sometimes we don't. But it is helpful to have someone in the conversation who understands these issues. I will tell you, and I'm not trying to make Adam look bad, but a lot of attorneys tell young companies, oh, go with the safe, and they'll tell them, hey, it's easy. It's no easier than doing a standard preferred round. They all have them in their word processors. They just don't want to admit it. They'll tell them that it's cheaper. It shouldn't be. And they'll tell them that there's a lot less work because there's a lot less disclosure. Well, I've never read anyone who really wants to talk about the requirements of the securities laws that says any security that you sell has a lighter disclosure obligation. So again, now I will say I'm sitting at the Keiretsu Capital Expo right now, and this morning there was one guy who did not want to put a cap on his convertible note or safe or whatever it was, because he is also simultaneously in discussions with VCs, and he's afraid that if he puts a cap on it this week, next week, that may blow up in his face when he gets a VC term sheet. That I thought was the one interesting pushback and the one legitimate conversation. I wouldn't accept it, but still, I thought that was an
I want
interesting.
to go a little bit deeper on why you wouldn't accept it.
Oh, same reason I don't like converts and safes in general. 100% of the risk and a fraction of the upside. If
Well,
you happen,
I was going to suggest that if he's hunting angels and he's hunting VCs at the same time, he's confused. And he probably ought to be focused on one or the other and understand that when he tries to mix them in an way that the layers are not aligning, he's just making himself a mess.
in his particular case, he is truly trying to pick up some bridge capital that will let him function comfortably while he does his VC round. And having been through this, I think all four of us have been through this. It's one thing to negotiate with a VC when you don't have to take their term sheet, and it's another thing to negotiate with a VC when they know that in 6 weeks you're not going to be able to make payroll. So in general, I do not like these kinds of deals. Every once in a great while, heck, I've even invested in a few safes and a few converts. And as a CFO, I've even done a few of them. I don't like them, but there are moments when every hard and fast rule should be broken, and it's appropriate, but it should be rare. But we've kind of gotten off of 1202 and qualified small business stock, so maybe we want to come back to that.
We do, but we didn't put a pin on what the question I asked. Who gets to decide the structure of the deal?
Again, it's a negotiation.
It's the founder who gets to decide, and then what they choose then determines which market they get to get success in, right?
Yeah, and really what they get to choose is they may have a preference about deal structure, but at the end of the day, it may come down to a decision about choosing who they want as their investor. And if they have an investor who says, I will not do a convertible, I will only do a priced round, the founder really gets to decide, does he want the investor?
Yeah.
Right.
But you're right, and thank you for refocusing me. It is the founder who ultimately decides.
And so the founders often are coming to us and asking us for our terms. And there's a certain amount of clarity that they should have about the choices they're making before they start raising funds. So there's some work to be done there. And this is also why founders should have lead investors who help them give feedback about what an appropriate choice is, which is why it's important for angel investors to understand how to be lead investors. And to do that coaching. Okay, so back to 1202. Daniel is going to do a price round. Daniel's going to sell me some stock. He's going to value his company in a reasonable amount of $4 million. His dog, and his marketing partner are the team. They start off running. Where does this go sideways? No thoughts on where it goes sideways.
So we're asking where does 1202 go sideways?
Yeah, so I'm using Daniel as an example so that he can think this out in extraordinary detail. So, we're at the early pre-seed where we've got an idea, 2 founders and some traction. And we place our money in, put in the $4 million cap and we put in our, 250,000. Now what? He sells the company before 5 years and then no QSBS, right?
That's right. Hey, sorry, John, in this fact pattern, investor purchased a convertible note and the note
No,
is
I was gonna force us into a priced round, but then
Okay.
I was gonna back my way up into the convertible note.
Okay. I mean, if you purchase shares and then the company exits, before you're able to complete a 5-year holding period, that's right. You don't get the benefit of the 1202. You can still, rely on long-term capital gains treatment, but you don't get the full exclusion under
Good.
1202.
Unless, because there is, listen, I got to tell you, if you get an exit in less than 5 years, that's a pretty good cake anyway. But if you're set up for 1202, there's even a cherry on top. When they passed 1202, the revision to 1202 in 2010, it really, mixing metaphors, they turned it into a Christmas tree. There is a provision that if you take your proceeds and invest them in another qualified small business stock within 60 days of your receiving the cash, your hold period now extends. So I got very lucky in one. It was very, very nice. I was delighted. It was, time to cry. I only made 5x in 3 years. So terrible. Paying my taxes would not have been awful. But I had a warrant in a company that I liked, whose value had clearly gone up and made enormous advances. I took a bunch of my 1202 proceeds, I rolled it, and I exercised my warrant. And I would, if that company had exited within 2 years, I'd been the only one in the company in that round to get qualified small business stock treatment, pay no tax. I also rolled some of it. I had another company that I was involved with who was doing a raise, and I rolled some of the proceeds into that. And again, didn't have to wait for that offering to mature 5 years. If it had been sold in less than 5, I still would have been qualified. So again, this is really, really nice. It is just a fabulous tax break, and there are a lot of ways to play this. By the way, so you would ask what can go wrong. An early sale, not terrible. By the way, if the consideration is all or part shares, and you don't sell them until your 5-year hold period is over, it applies. And by the way, the shares that you receive in that transaction do not have to come from a qualified small business. So if your company happens to get acquired by Microsoft and you get a bunch of Microsoft shares, you just need to track them and remember that when you sell those specific shares, talk to your stockbroker and your accountant about this, you would still get qualified small business stock treatment on that. Very, very cool. So a lot of neat things to be done here. Again, you just got to keep records. What else can go wrong? By the way, the biggest thing that can go wrong is the company fails, but we'll ignore that one for the moment.
Yeah, we're going to come back to that.
That's the 1244. But what else can go wrong? The company redeems shares in excess of the de minimis threshold within a year of you making the investment, which creates the equity. So if you buy equity and then they buy out a shareholder and they buy it back into the company rather than arranging for other shareholders to buy it, and they buy back 15% of the stock, they've blown it. Now, let's talk about the one other piece on all of this. You may never know about it. When we do these things at Swan, we have a side letter which says you undertake to use reasonable business efforts to not blow it, including agreeing for a year not to redeem stock. We always say reasonable business efforts because we don't want to handicap the company if there's truly a business necessity. And it's a polite way to do it. So particularly if you're investing as part of a group, a bunch of you friends getting in, you can negotiate some of these things and they're not unreasonable. And I have generally found that I don't get a lot of pushback. I sometimes have to explain to the companies and even their attorneys why we're asking. But frankly, if someone pushes back on these kinds of things, you probably shouldn't write the check in the first place.
I think that's an important thought, right? When people are setting things up and they don't understand what they're doing, and there's lots of fighting going on around things that should be simple, it's
Yep.
probably the wrong investment for an early investor.
Can I say,
Yeah,
I
go
mean,
ahead, Adam.
this can get very, very complicated. I mean, when I do M&A work for, clients that we haven't kind of assisted from the beginning, usually there's a pretty detailed kind of 1202 analysis we do, assuming, they issued at least some qualified small business stock in the company's lifetime. And finding these redemption events and kind of the tainted windows that they create in which the company was ineligible to issue qualified small business stock, it can become a real shock to some of these founders to learn that a significant amount of their holdings is not going to be eligible for this treatment. And remember, you have to kind of run the analysis for each block of stock, because a lot of founders will receive, their stock and, not just at the beginning, but in several allocations, and you need to assess kind of each block of shares that you receive.
Which means that you need to be keeping track of every transaction in some orderly manner so that you can find it.
Yeah.
Which is, I think, one of the most likely ways that this thing all goes sideways.
Yeah.
Actually, John, sorry, Adam, there's a software that we use that tracks the stocks. And literally, we put in all the investors, all the founders, everybody coming in. Then we assign. So in Peter's case, Microsoft comes and buys you. We'll put in exactly this in this date, this in this shares, everything that's recorded in. So you have these records. So at least we prevented one part of the going sideways by the strong record keeping. And that we require for everybody.
And let me point out something else. Guys, if you have even a moderately decent exit, gee, what a terrible thing that you're going to pay tax at a substantially lower rate than you would on earned income or on interest. What a terrible thing. When we're talking about qualified small business stock, we really are talking about not only getting the cherry on top, we're getting whipped cream, probably some chocolate sauce, maybe nuts if you like that. 1202 qualified small business stock is a wonderful thing. And that we get it is fantastic. And if for some reason we don't get it, it's not the most terrible thing in the world.
Speaking of cherries on top, some states have followed places like British Columbia, and they provide a state credit for your angel investing. So if I'm investing in British Columbia as a Canadian, then I get a 30% tax credit every time I do an angel investment at the very beginning, right? So I know Maryland does this. I know that Minnesota does this. I'm pretty sure that Washington doesn't do this. And so, Joseph, you're over in Florida and you do a broad range of states in terms of providing services. How does the QSBS 1202 thing connect to the state issued credits?
So usually you're not going to end up paying. I don't say usually, but what I found is when we're preparing up the returns, we're taking all the information in. You will have to file, especially if, let's say we get into the K1s, all those discussions. You will file those. There will be a zero tax liability, but we still have to do the filings for each individual state.
Yeah. And then, you know, have you ever done a return where the company had a state credit?
Yeah, I believe it was for Pennsylvania. There was nothing. It was Pennsylvania, Florida. We didn't. I have not. I've been living here 10 years, but I still haven't had that opportunity on those returns for here. Most of them are out of state. Like I said, the M's, yes. Some of the other northeastern states, yes. New York is a little bit wacky on its tax laws. I still encourage everybody to move out of New York as much as they can. But more and more states, you'll see on, I get the Google News feeds, you'll see almost every other day more and more states are offering those credits. They do want the investments, they do want these companies to be set up in their states, and they're literally offering incentives left and right.
Yeah, so the one that we looked at most recently was in Maryland, and they would give tax benefits to anyone that invested in the state. So the investor didn't have to be in the state, which is different than what British Columbia does, right? British Columbia requires both to be in. And in the same way, the UK also has a very nice tax credit that requires both to be inside the UK, right? But the Maryland one also allowed foreign investors to get the tax credit, which I thought was an interesting complication. Is there a pathway where my angel investing entity that I do my angel investing in is actually hosted in another state, and now I get tax credits over there to that entity?
We,
So, John, you're going down a path that is, you're talking real edge cases.
Okay.
It varies state by state. A lot of states, these programs go on, they go off depending on their budget situation. I can tell you, we did one in New Jersey, and I've been spending 3 years trying to get my rebate from them. I have yet to figure out if I get that, whether that's a reduction in basis. Logically, I would, but I don't know what the IRS says. How it interacts with 1202 is even more complicated because not all states recognize 1202. So for Washington capital gains, the guidance I have from my accountant is that that Washington follows the federal rules. California, I believe, does not. Again, no one should take my word on this stuff because I am not a CPA. I have never filled out a tax return in my entire life, and I may not know what I'm talking about. Other than that, state taxation on this stuff is very, very complicated, and probably, except possibly for Adam, none of us should be giving opinions or ideas on it.
Yeah, well, but that leads where I want to go, which is there's lots of these little places where you can start playing the edge cases, and it gets more and more complicated. And the more you do that, the less and less likely it is that your CPA is going to actually understand what you're doing and is going to actually be helpful along the way. In fact, there are many CPAs that I talk to that are, I'll say, angel investing blind. They don't actually understand any of these details at any level. Do you see that, Joseph, that there are some people that, are CPAs, do the regular tax thing, and then you bring in a bunch of K1s for this angel stuff, and
going back to your Maryland case and the foreign investors, I'm not purporting to do it. I'm not purporting it's a great idea, but right now there's money coming in from foreign investors, no matter which, Dubai, Asia, Far East Asia, that's where we're going to raise funds. We set up the entity in Maryland, we'll set up in Wisconsin, Wyoming, any one of those type of states. And we set up an office location, whether it's full office, half office, we set it up. The company's registered now in Maryland. We take full advantage, putting in the foreign investors. Again, for your regular taxes, You can have regular federal forms, you can have a bunch of foreign investors. You're just reporting them in as foreign investors. For Maryland, for them to get those credits, it doesn't matter to Maryland either. Bring in your foreign investors as long as the money's coming in. And in the states where they don't, where they want, and you're getting the credits, I don't want to say we're on the edge, but you have the affordability, you have the ability to be able to set it up there and to accommodate investors, not just in the United States, but foreign investors too. It is a little tricky in the paperwork. It is a lot more paperwork for the CPAs to do. They might not want to do it, but again, your hope, when I look at it, I say, you know what, on 100 clients, 80 might not succeed, but 20 will, and I will recoup back whatever I've expended. I'll recoup back on those 20. So for me, it's well worth it to say I won't get all my full fees, but at least let's do what's right for the client, and we'll get it back on the other terms.
Yeah, yeah.
So John, we really have gone far afield from
Yeah,
1202
yeah.
at this point.
Let's
Yeah,
go
so
back. We see some questions in the chat I want to address. So one of the questions is, as we're tracking our stuff, is there good software that the company should use to track their cap table and their stocks and so forth?
I mean, by far the most ubiquitous still is Carta. I'm sure there's other solutions, but I mean, 9 out of 10 clients of mine that are using some software like this are using some paid version of Carta. Or I know they have free versions up until certain financing milestones or time, or time periods. So they're trying to make it easier to access initially before you're a
So,
paying customer.
so I have a database of over 35 SPV provider companies,
Yeah.
and many of them are starting to add this as a service
Yeah.
as they start to see that they need to compete more directly with Carta. And so there are many choices to it. Joseph, you mentioned that you had one. What one are you using?
Carta.
Carta, okay.
We
Yeah,
put it on, we make everybody have to sign up the subscription. We handle it for them, but they have to sign up with.
yeah. And so we noticed that when our company, well, SAC 6 went public, that Carta is not able to do whatever like CompuServe is able to do on the public markets. And so in the process of selling those shares, they had to transfer everything from Carta over to CompuServe. That seems like a strange place to have problems if we're regularly doing cap table transfers of some kind.
The,
It
the,
does.
the fact is very few companies ever get public. So, you want to talk about edge cases. That's an edge case. That's an edge of an edge case. I just pulled up one of my Carta accounts. Carta is now attempting to track 1202 status. I'm looking at Swan Venture Fund 3, and their comment is QSBS status, and it shows as likely eligible. Let me look at something. Let me look at one of our much older word here. Let me look at something that's got much more aged investments. And where they should be QSBS eligible. And I'll come back and I'll take, but Carta is definitely starting to track this information, which is very, very nice. Let's see, I'm not seeing it in here. I don't know why. But anyway, so that is coming. By the way, and again, Adam, Joseph, cover your ears, maybe close your eyes. John, you can listen because you don't hold a license. The IRS doesn't really have any good way to track this stuff. And when your company sells, I hear rumors that they've got an obligation to report, but the fact is, whatever my companies report, if it isn't right, I stick notes in my tax files and I file my tax things, sometimes with an adjustment showing, and I make sure that I'm properly taxed, whether that means I pay less or more tax. And I'm sure you guys can figure out how often I volunteer to pay more tax. Again, this is not legal or accounting advice.
It
Uh,
it almost almost exclusively comes up in audit scenarios, frankly. And sometimes in these M&A analyses we do, but you know, we'll have an investor ping us and ask for a lot of detailed information because they're undergoing an audit and now need to prove either 1202 or often 83B types of issues. So
So,
um,
so shifting the conversation a little bit, we see that there's this QSBS stuff, and there's a certain amount of paying attention you need to do, and probably you need to talk to your accountant to make sure that your accountant tracks that and that you're using tools to track that. But one of the things we have with very early angels that are maybe, 1 or 2 million in net worth coming out of the tech sector, they don't have free cash laying around in their checking account, and they start looking for other places. And so one of the questions is, can I invest out of my IRA? Right. And so, Peter, can I invest out of my IRA?
You certainly are able to if your custodian will allow you to do alternative investments. Most custodians are pretty difficult about this because it is to use a technical finance term, a pain in the tuchus. And now, this is the classic just because you can doesn't mean that you should. And there are a bunch of reasons to think about whether you should. First of all, particularly if you're in a Roth IRA, you're
Let's stay with the regular IRA and then walk our
okay.
way over.
All right. So a regular IRA, you should remember that once you hit age, I believe it's 72. Adam, correct me if I'm wrong. Or Joseph, you're the accountant, you probably know this better. You're required to distribute required minimum distributions, RMDs. I think it's 4 or 5% of the value of the account each year. That's not a problem with things that are cash or publicly traded because you have objectively discernible prices. When you're holding these illiquid, unpriced things, even if it was technically a price round, you don't know what it's worth. Yet somebody's going to have to send in a valuation report to your custodian each year. And the deadlines used to be, you could stretch it out until August or September. Now they're pushing you to deliver this information by February 15th. I am the manager and the administrator again for the Swan funds. Well, we don't, even if we wanted to do up to date valuations of our portfolio companies, which we don't, because we don't think there's any economic validity to writing things up until they turn into cash. I don't have the information, and the companies often don't send me enough detailed information to do it. And frankly, I've got better things to do with my time because I don't get paid for doing valuations, and I don't want the personal liability of making a guess and being wrong. So I resist doing this. And you, as an investor in a Roth, should resist doing it because, let's say that something terrible happens and you have a massively great exit 2 months after you tell them that your investment is worth $40,000, and all of a sudden it turns into $875,000. And now they're wondering, did you play games? Did you or should you have known that you were going to get this huge thing and you're under distributing your required minimum distributions? I wouldn't do it. It's just a pain. Oh, and by the way, 1202 continues after you die. It's the investment that has the 1202 characteristic. Your IRA has to be distributed within 10 years of your death. So you lose your 1202 in that case, I think. Again, Joseph, you may correct me on that. But who needs this kind of confusion and complication? So that's where I am. Unless you have no other source of cash and you want to make the investment. That's the one reason to do it out of an IRA.
Right. But when you're doing a regular IRA, you invest your money, you have a 60-70% chance that that's going to be a loss, and you can't do anything about the losses. There's nothing that you can write off, right?
Right.
So you can't take advantage of the losses. And then the other way, you make the $879 win, and then you have to pay regular income tax on it, not capital gains tax on it. So it's regular IRAs are a loss twice, right? So then we can say, let's not do pre-tax, let's do post-tax and do a Roth IRA. And now the Roth IRA still can't manage the losses because you don't get to write them off because there's no mechanism inside the IRA to do that. And then you do get to not pay taxes on it, like Peter Thiel is not paying taxes on it. So you want to comment a little bit about Peter Thiel and his $1 billion
Sure.
Roth IRA?
Sure. And before we get to the Peter Thiels of the world, let's stick more with the Peter Weisses of the world, because I'm probably more representative of the people on this call. So if you have cash in a Roth IRA, you're not going to pay tax on the gains, but you're limited in how much cash you can contribute to a Roth IRA. So here's 1202. You can do a parallel thing and you don't have to pay taxes, and you have two vehicles that can allow you not to pay taxes. To me, that's kind of cool. As John mentioned, you also have the inability to take losses if it's in the Roth IRA. You also have, as I said, the required minimum distribution obligations, and the Roth IRA, like the regular IRA, I believe after 10 years has to be distributed. And I don't even know what the taxation is to your heirs are at that point. And I don't know, again, this is a Joseph question, whether the Roth IRA goes into your estate and what the valuation is on that. Peter Thiel. Peter Thiel is extraordinary in all kinds of ways. And I won't go much further than that on my comments on Peter Thiel. He is a very interesting character, a very, very interesting character. Peter Thiel, brilliant as an investor, brilliant as an entrepreneur, funded his founder share investments out of his IRA. And Peter Thiel was there at the beginning at PayPal and a whole bunch of others. And he has been enormously, incredibly successful. And these investments are now seeing, do you know if they're in a regular IRA or a Roth IRA?
They're in a Roth.
Okay, so his Roth IRA is, we are told, worth well over $1 billion. When he distributes that to himself or somebody, he will pay no tax on it. God bless him. It made particular sense for him with founders' shares to do that in a Roth, because the Roth doesn't have the cap of the greater of 10x or $10 million. And with founder shares, it's a lot easier. If you're going to have a rocket ship and a great success, it's a lot easier to run into those limits. Normal angel investors, if we're putting in 25s, 50s, 100s even, we're unlikely to ever run into those caps on any individual investment. But for a founder playing the big Silicon Valley kind of game, yeah, don't do it. Instant 1202 is not the worst thing in the world. You still save a whole bunch of money on taxes if you have a big success. But putting it into a Roth, man, that is just tax planning brilliance. And that's getting a cherry on top of a lightning strike. It's great. God bless him.
So we should mention that the way you get extra money into your Roth IRA is through IRA conversions. And so you can take your regular IRA and convert it to a Roth IRA, and you have to pay the taxes at that point, but you can get a bigger chunk of money in over there if you want, right? So instead of the $6,000 a year that you're popping in, you can, roll a bigger amount in. Now, this 1202 QSBS thing, does it apply to founders as well as to angel investors?
Yes.
Yes. In fact, I mean, part of the original kind of idea behind this was it would encourage the creation of startup companies. And so it was kind of originally intended to help the founders. And then then the investors as well. So yes, I mean, this applies to founder shares.
So it's worthwhile for founders to be thinking about their tax consequences of how they fund the company that they're starting. Using a Roth IRA is not a bad answer if they have done their corporate, servitude and they have a pile of money there. They can do that and get some benefits out of that, but they don't get to manage the losses, right? There's a trade-off there. So Peter, do you want to go in a little bit on what do you do with angel losses when you just put regular cash in?
Sure. Now this becomes a different conversation. We're now no longer talking about qualified small business stock under Section 1202 of the Internal Revenue Code. Now we're talking about startup losses under Section 1244. 1244 is an interesting section, and I have to say I didn't pay much attention to it until recently when I was suddenly able to take advantage of it. 1244 is available. I believe it's limited to C corps. Again, Joseph, correct me if I'm wrong. And it is available to the investors who provide the first $1 million of investment in a company that goes under. Now, this gets a little interesting. If they're raising $1.5 million round, the question is, are they taking you sequentially or are they doing one big close? If they're taking you sequentially and you want to be in the first million, I've never seen a company that was clever enough to promote that, but promoting that if I fail, you're going to get a better write-off, not the best selling point. But if they do a grouped close, then it's done the one time I've seen this done, it's done on a pro rata basis among everyone who's in that. But the beautiful thing of it is the 1244 loss is treated not as a capital loss, but as a loss which offsets virtually any type of income, which includes earned income. So if you're self-employed, for example, and you got to watch your state treatment, but it even reduces your Social Security and Medicare tax. If you have a company that fails and that you happen to not have a very good year, it offsets interest, it offsets rent, it offsets royalties, partnership income. So this again, talk about, again, this is the cherry on top of what you were hoping to be the cake. Well, it turns out they took the cake away before you got a slice, but you still get the cherry. And, yes, failing is never good. Making a bad investment is never good. But I will say, as a CFO, and over the years, yes, I have had some companies that I've had to help close up. I've always made it a point as a CFO to get the best outcome for my investors. I take that as my obligation. And when I'm able to give someone 1244 treatment, I go out of my way to let the people who are eligible for it know. And I also actually, as a CFO, I explain to them what it means because almost nobody has heard of 1244. I will say they get pretty excited when they find out that depending on their personal tax situation, it might be worth as much as 45 cents on the dollar instead of 20 cents on the dollar. Again, no one likes to lose, but if you're going to lose, do it as best you can.
Does this also apply to founders if they have put cash into the company?
If they've put cash in, yes. And if they've contributed assets that were documented on value, probably yes. Again, this is a Joseph question. I'm not a CPA and they don't do tax returns. By the way, Charles just asked the very good question, what documentation should you get from the company? So number one, you should keep your record of having made the investment. And number two, you should ask the company whether you're, in the first $1 million of invested capital in the company. And frankly, in a situation like this, by the way, there's absolutely no reporting on 1244 that goes to the IRS. My feeling is an email from the CEO or CFO saying, yes, you're in the first million, or even 4 years later, yes, you were in the first million. That's probably going to be more than enough for the IRS to be happy. again, Joseph, you may have a different view. Adam, um, if Joseph gives me advice that turns out to be wrong and I'm on my way to jail, I'll call you and find out what your view is. But the fact is, again, now Peter can say this, these other guys can't. The IRS is very rarely going to look at this kind of stuff. It's generally going to be small dollars.
So what kind of thing do I need to, what form do I have to fill out to claim 1244?
There is a form on the tax return, and I know because I've gotten a couple, and it just my accountant pops it into wherever it goes and it shows up. I have no idea.
There's really no special reporting. Like Peter said, there's no IRS coming back to really look at you. And again, it's a one quick one sheeter. You're putting down the name of the stock, name of the company, putting down the date of the loss, that you acquired, how much you lost, how much you put in, and that was it.
Okay, that seems easy enough to do. But again, you need to have a CPA that's paying attention to these things and knows where to find it and isn't looking it up, right?
It's all part of the questionnaires that, every year your tax situation changes. Every year you've got to ask these questions, or you have to let him or her know.
Yeah.
And
So
and the truth the truth
Charles,
is, if you have enough wealth that you're doing angel investing, you probably already have some other investments that are generating some interesting questions, some real estate and stuff. Um, the accountant who was good enough for you when you were 23 and everything that was coming in was W-2 income, or when you were 28 and it was W-2 and some 1099s from some interest and stuff, or coming in on a brokerage account, is probably not the same accountant that you should be using if you have made a bunch of money and you're now in your 40s.
right. Yeah, that becomes increasingly clear. Charles asked the question, can it be a partial loss instead of a total loss and you write it off?
Don't know.
No? So
I don't know.
oh, you don't know. How about you, Joseph? If I put in my $10,000 and I get, my $100 back, I get to write off $9,900.
We've written it off over multiple times. What happens is there's a form there also. Part of it is also, do you think the loss is fully in that year? Do you think it can carry over to other years? And again, it might not be in your best interest to take it in the one full swell swoop. Break it out over a year or two, 3 years.
So does the angel losses carry over into the future? So I've invested for 10 years. Now I've discovered, oh, I should have been taking losses against my angel gains. Does that,
They
can I,
expired worth. Well, John. That's a good question, because if they expired worthless already, go back in. I mean, I could tell you what I would do. I would go back in at least to say now it expired worthless, and see if there is some potential write-off I would do. If it expired 10 years ago and now you're only doing it, if you're ever audited, the question will be, well, why did you wait 10 years? Your answer could be, well, I really held on to the stock. Don't relinquish the stock. Keep it and say it might be work. But if the company goes completely kaput, I wouldn't wait 10 years to do it. 1-2 years saying, okay, maybe if I had a personal guarantee or I had nothing, but then again, it's not stock at that point. Then we get into the notes.
right? So Peter, we've had this back and forth for a few years about angel investing and how risky it is and who should do it and who shouldn't do it. And so I wonder, I'm wealthy enough. I do a little bit of my real estate investing. I do a little bit of my angel investing. Which of those are the riskiest asset class?
Look, number one, risk is a very personal issue. But if you're going into long-term, illiquid, highly speculative assets, and angel investing is certainly not the only class like that. You need to make sure that you're not putting in more than you can afford to never see again. And I see people who get very, very excited about this, and all of a sudden 20-25% of their assets are in something, and something goes wrong in their life. They lose a job, they get sick, and now they have a problem. They can't get to it. Um, the accredited investor rules are designed to protect people from not from making legitimate, appropriate investments, but from getting carried away with their enthusiasms, their excessive beliefs in things. Um, I've been doing a lot of work analyzing some large angel portfolios. I believe we have to go into these deals assuming that it is going to be somewhere between 12 and 16 years before we see our money. I had a very, very successful exit on a company that I had most of my equity in just over 5 years, go qualified small business stock. Um, but that company had been founded more than 25 years before it got to its exit. And there were still people in who were in, um, the difference between a 5 year and 3 month hold and a 26-year hold, on IRR is substantial. And by the way, there were people who went in 3 or 4 years after that company started when it was doing better and it was the hot .com boom, who got in for more than they got out 20 years later. So you got to be careful about this stuff. And listen, John, I am sure that you have had some of these things that, at some point looked like you already had a locked in 30x and ended up being zero. I've got a couple of those. Swan has a company that we helped get going that was great. And at one point, we were working on selling into a secondary. The company wasn't going to sell the VC enough. The VC wanted more. And we were looking at well over a 30x. And then something external happened and we couldn't get the sale done. And we're not sure that we're going to see a penny back on that investment. So, guys, highly speculative, very risky. When they hit, they're wonderful. 1202 makes it so much better. It's great. And when you get that email or the check shows up, man, it is a good day. And go treat your spouse or your kids or whomever or your parents well, and enjoy it. But you're also going to get a lot of those letters that say, by the way, nothing's happening here, or worse, again, change in life circumstances. You're not going to be able to get cash for it.
Right.
So,
So if I'm in real estate, the probability that I can sell it, even if it's pennies on the dollar, is very high compared to the probability I can sell my angel shares, which is inordinately small. There are some little secondary possibilities in various ways, but almost never for stock that's putzing, only for the ones that are growing fast, and are capable of getting like VC interest to buy you out kinds of things. And so um, that liquidity is really a big, important question. And so if I take my net worth and I say, I'm going to put a limited amount of my net worth in that I can afford never to see again, and then I lose my job, I might feel like that 10% was actually important to me. So I might want to be a little bit careful about how I do that, right? So on the other hand, I rarely see a path where my angel investments require me to put more money in after I've already lost all of my money for angel investing, where I have had the personal experience where I've had to put in more money and cash into my real estate investment than I put in at the beginning of the real estate investment because of some cascading failure process, right?
Yeah.
So there's risks in these and you should pay attention to them. Have we covered all of the points that you guys wanted us to cover?
John, at some point, I want to go back. Nick asked a few good questions, which will be maybe interesting for people who
Yep.
have been participated in SAC before. So I wanted
Yeah,
to go
yes, please.
back on that. So Nick, you first asked, I mean, if we can kind of all get our minds back to 1202 and qualified small business stock, you had asked what kind of safes SAC has purchased before. And to my knowledge, it's never purchased kind of a debt operating safe. It's always been kind of the standard kind of Y Combinator forms of safes that are really just a contract to receive equity at some future date. No interest rate or anything like that. If you actually go and pull up the most recent forms on Y Combinator's website, they started adding a paragraph to the very end of the safe, which basically says that the company agrees that you can take the position that this safe, the purchase of this safe and the issuance of the safe starts your holding period for purposes of 1202 and some other tax sections.
By declaration.
Right. And so that's new. I mean, that they started doing that. We've started actually incorporating, when I'm representing the company, or the investor, we've started incorporating that language into other forms of safe.
But Adam, when I've looked at those paragraphs, um, all of them have omitted the second paragraph, which says, "And we promise to pay any taxes that might be due because the IRS doesn't agree with this treatment." And it's amazing. Every single document they've forgotten to put in that extra paragraph.
Yeah. Well, you must be working with some some pretty generous companies. But good point. So I mean, Nick, to the other part of your question, I mean, SAC has participated in direct equity, kind of Series C or Series A, preferred stock financings where it's buying preferred stock directly. It's purchased convertible notes. It's purchased safes. But most commonly, and especially in the last handful of years, it's the convertible securities. It's convertible notes or safes, and safes have been really popular the past few years. And so I'd say that's where kind of most of the finalist companies end up kind of talking with SAC about what the deal structure is going to be. That's kind of on the top of their mind because they have a current safe offering going, and that's what they'd like SAC to purchase as part of their investment.
So about half of the time, the companies are already coming in with an open round with already having accepted investors. And so at that point, we are then engaging in that deal. We're not trying to negotiate a second deal with a different set of terms. And so about half the time, it's just, is the deal they're offering one we want or not? And that choice is up to the SPV organizer, right? They get the choice to veto the companies before they get into the finals, and then again veto them after the due diligence of the finals, whether or not the deal is okay and that they can see how that deal will work out. Yeah. So I'd like to open it up at this point for questions. So I'm going to stop the sharing of the spotlight here. Hold on. I have to do it one at a time because I haven't found another way to do it. And then open it up to questions for everyone. So if everybody'd like to turn on their thing, and if you have a question about any of this, let's dive in for a little bit. Any questions? Nick, Daniel?
Yeah, I guess I have a bit more of some generic questions. It sounds as if a lot of angel investors, um, um, or just investors in general, and founders should be looking for a good fit. And this is something I keep going back and forth on in terms of how to define that good fit. So, other than the revenue potential, or that a lot of companies are looking for, put that aside. Let's say that's in the bag, of course. What makes for your good fit? What are you looking for?
So I would argue that, there are classifications of hard, right? If you're computer science, there's like NP hard kinds of things. And for most normal people, we use marriage as a definition of hard. And so when you're doing startups and you're doing investments in startups, it's a relationship-based activity, which is in the same order of hardness as being married, except it's like being married with kids, right? There's lots of little details. There's touching on a regular basis that you need to be doing to try to make sure everybody's in agreement and that things are going. And then when you don't communicate well, things get twisted and you can destroy the whole thing by having the wrong communication or the wrong mix of partners. And now when we're angel investing and we've got 50 people that are in this thing, the possibility of the wrong partner is significant. And so it's well worth understanding it's a relationship-based activity. Peter, you have a better answer?
So it, it's more an issue of noticing disqualifiers. If I start having any questions in my mind about integrity or character, either with the CEO or other members of senior management, I try really hard to forget all the other things I like about the company and walk away. Because at the end of the day, there are going to be very dark, hard nights. And if integrity and character is not there, you as an investor are in trouble because you have no control. But that's really subjective. It's hard. I do I do ask people about folks. I do a little digging around on the internet to see what I can find. But again, to me, that's a near killer if I don't find it. Um, the rest of it,
Even if they have integrity and you sniff something that makes you feel like there's a problem with integrity, it can destroy the relationship anyway. And
yeah.
so you have to walk away at that point.
Well, and the truth is, as an angel investor, you're not going to have much of a relationship, except very rarely, with the people you're investing in. I tell them you can call me and ask me questions anytime you want. I know a lot of very useful things, and I know a lot of very useful people. And it's amazing how few calls I get from the companies I invest in. I don't take it personally. Um, but they're running a business, and now I've heard people applying the would I want to have a beer with this person, late on a Thursday night. That's a lousy criteria. I don't think that makes any sense. I think there's validity to thinking about it in the concept of the marriage that John used, but you're not getting married to this person. Um, you're hiring someone who you want to be a good, honest steward of your family's money and who is going to try to treat it as well as they would their own and who wants to behave well. Um, we may eventually have differences in opinion on what behaving well is, but you want that fundamental thing to be there. Whether or not I like him, my father used to tell me a story about how every year he and my grandfather would go to Europe and they would meet Mr. Finder in Rotterdam and they would negotiate the contract to import the Hungarian salami for the next year. They hated each other. They absolutely loathed each other, but they had that business for over 25 years. They all made money together. And you know what? It didn't matter that they didn't like each other because they managed to do things together and it turned out very well. And everyone was very happy for as long as it lasted. So, do I need to feel that I'm going to have a beer with this person someday? No, I don't really care about that. I just want to know that they're going to do a good job of taking care of my wife, my kid, my sister if something happens to me.
May I offer? Peter did a good job kind of sharing the investor perspective. I lead a conversation with kind of our company clients a lot of the times around their financing strategy. And I try to remind them, and bear in mind, it's been a brutal couple of years to try to raise money as an early stage company. But it is a two-way interview process. You're interviewing prospective investors to participate in your company, and it needs to be a good fit for the company as well. That said, I mean, there's a couple of categories of investors. Sometimes you just need cash. And there are those types of investors who are easy to write a check and won't be very involved, and that's just fine for everybody. And other times, wouldn't it be nice if it was more than just an investor and it came along with some resources and a network and some connections and some expertise in my industry? Of course, that would be nice. And so if that's on the table as well, I mean, that may flag that some investors are more attractive than others. But I think there's room for both. I certainly think there's room for just the kind of silent cash investors, and those who are going to be a little bit more involved in the business.
Charles, I see your hand up.
Yeah, John, well, first of all, thank you for answering my earlier question. I very much appreciate it. John, I'm just curious, have you ever given any thought, at the beginning of a SAC process, sharing kind of we are looking for as a minimum to have the following things in the documentation that we ultimately we'll look to negotiate, with the winner of SAC, so that, we're not kind of getting to the last, kind of stretch of the race and finding out that, a company has got something that's just a line in the sand that we probably would, if we had known about it, not chosen the company to go forward with. There might have been another company that we might have gone with. It seems like leaving sometimes the negotiation until the last run's a bit of a risk.
Sure, but understand I have an education program, not an optimized investment program. And my goal is first to get investors to answer the question, is this a good company? Without evaluating the deal, because if I tell them the deal, they collapse the whole conversation to the deal conversation and they don't do their homework.
Right.
And so I'm trying to get the first time investors to just answer the question, is it a good company? Does it have momentum? Is the team the right team? Do your homework, right? And then the second person coming in for the SPV organization stuff and playing the lead investor role, they're the ones that need to negotiate the deal. And so that's the learning by doing process for the SPV organizer. That starts in the quarterfinals round where the SPV organizer is doing that work and has the opportunity to veto people and get them out because the deal is stupid in some way or another. And so out of the collection of companies, we have the opportunity to throw away a bunch of companies without them getting into the final because the SPV organizer does their homework, right? Now, once everybody knows what they're doing at some level, sure, we can optimize that better. We have workshops that we talk about the deal terms. We have workshops where we talk about how the structure of a deal should happen. But that doesn't force everybody to pay attention at the same time, which is a disadvantage to how we have things set up. But our real goal is to get more people to be lead investors who know how to negotiate a deal, which means they should become SPV organizers. And we're trying to cherry pick them out of the program to get them to do that. And our sidecars are actually helping that expand a little bit as we get other people who start doing that. And then we have those conversations. We just have those conversations in private with the people starting the sidecar.
Okay, I guess my and I hear what you're saying. I guess the point is, when we got down to the group of 6, it sounded like that there had been some conversations with the person that's leading the negotiation, but I'm not sure that that information is necessarily being shared, with the rest of SAC. And we get to the point where in a lot of these cases, we're down to 2 or even 3 companies that ultimately I think we would feel, pretty close to being comfortable with going, with either of those 3. But if we knew a bit more in the way of the, negotiation stances, that might swing us towards one versus another. So
guaranteed it would swing. And the evidence that we have so far from our past experience is the cheaper stock wins. And cheaper stock is not the better deal. And so the voting by the group, all I want to know is, can I get a reasonable thing? And that reasonable thing is the responsibility of the leader. And the group as a whole needs to answer the question, which of these is the right one as a business? And I separated that intentionally because when we've done the let's go into the deal terms in the finals, what's happened is, oh, this is a really good deal. They're priced at 3 million, not at 7 million. We get so much more of the company. Bang, the conversation is done, and the evaluation of the is it a good company gets thrown out the window.
Yeah,
So
I can see how broadly speaking that would be the case. Okay, all right. I guess it for those of us who want to go into more detail, I guess we've always got the option to reach out, to the person leading the conversation, and we can have a sidebar.
Yeah, certainly that's true. But it's also, there's a point at which that becomes extraordinarily important to you, which means you as an investor are starting to have perspective, which then means you probably should be looking at like venture as a fund where you spend less time at it and get more investments and get to do that earlier. So venture is the active angel fund model that will produce a better portfolio that's optimized for investment, not optimized for learning.
Okay.
Yeah.
Thanks.
And for like Vin, who's out of the area, Venturous is based on, if you follow the track back in the Oregon Angel Fund model, and it's basically a group investment where all of the angels do all of the work. So as a whole, they do the process altogether, which is somewhat different than most angel networks. For example, actually, I should ask you this if I have a biased opinion with no data here. Does Swan do fund or does Swan do network? Peter? You just turned it off.
Sorry about that. So Swan is a fund, but we encourage our members to do sidecars. And in fact, picking up on some of the earlier comments, we are formalizing our process to make sure that coming in, there is an agreement that our members, if they come in and do sidecars, are also covered by the same agreements that we have, that any side letters apply. And in fact, we will be trying to negotiate that for purposes of major investor provisions and stuff. We are accumulated because when you come into our room, the current fund has 42 members plus the fund. You know what? We probably hit a lot of the major investor provisions, and we don't want to be carved up into little pieces. We want to be recognized for what we've delivered to these companies.
Right. So in my mind, when I say fund, money comes first, company comes second. And then that process of who makes the decision determines the kind of fund that you've got, whether it's a managed fund or a passive fund or an active fund, is an important decision-making question, which then fundamentally changes the experience of the participant.
Correct.
So
now, we are also a member managed fund. The investment decisions are made against some pretty tough quorum requirements. So no individual is able to sway the group sufficiently to either drive an investment or to block an investment. And we set it up that way very much, very specifically.
Yep. Peter, I can't find your website. It says WordPress thing coming soon. And Charles is asking where you can find out more about Swan in the chat.
You know what? Send me an email. I posted my email a few minutes ago, and I'll do that. Our website has been kind of casual, and it's something that we're working on improving now, but we haven't done a great job on it.
Well, a one pager with basic contact information would be a step up coming soon.
Yep.
Yep. All right. So, any other thoughts or questions from anyone about angels and taxes and IRAs and USDA? Yeah. So, Vinay, why don't you tell us what you're thinking tonight?
So the idea is, John, I'm not sure how many times have we done the sort of same discussions before.
This
But
is what we've done this month.
right, so for new angel investors, if we can document this at some place that is available readily and managed by SAC, I think that would be a great idea. How do I say, this is your 101 sort of.
On the YouTube channel, and then if you look at the bottom of the notes we've been taking, Peter has a really nice 202 1244 document in there, and we can start with that, and we'll turn it into something we can make a little more public.
Right, I think YouTube channel is one part, but if we can document it, I think that's a great idea as well.
Yep. Any other thoughts? Prakash, you've been quiet.
Yeah, I've been new to this, so just absorbing information at this point.
Okay. For companies, if you know a startup that should be coming in, we're starting to get to our 60 limit. But if you know somebody that would be good to come in, the deadline is August 27th, but they should just apply really fast, get in the thing, and then edit their profile afterwards, because we won't show it to the investors until September 3rd. And if you have someone that wants to know more about angel investing, we're glad to sort of help them find the pattern that works for them. Thanks everyone for coming. Thank you so much, Joseph and Peter and Adam. It's really great to be able to pull this conversation together this way. I think it's a topic we haven't engaged in deeply enough in the past, and I think we need to think harder on it. Thanks everyone for coming.
My pleasure. Thank you.
Take care.
Bye, everyone.
Bye-bye.